Okay, so we're going to give a brief rundown on the new Wealth Partner Multifamily Property Fund. This is an excellent fund that we've introduced to help bring our investors together in order to acquire income-producing properties that will cash flow on terms. So we're going to start by giving a brief rundown. The example property we're going to use is actually a real property that we recently acquired with the program. This is a 10-unit property in Reno, Nevada. 5,000 square feet, 100% occupied. This is your NOI. Your NOI stands for net operating income, and basically what that is that's your monthly rent proceeds minus your monthly expenses times 12. And so with this particular property, your net operating income after all expenses to maintain the property is $42,000 a year. So the purchase price on this property was $395,000. Which gives us a cap rate of 10.8%. The way you get your capitalization rate is you take your net operating income, your NOI, so in this case $42,000, and you divide that by your purchase price. So effectively, if you were going to buy this property cash for $395,000, when factoring in your $42,000 annual net operating income, you would be earning 10.8% cash-on-cash return on your investment of $395,000 cash. So now we're going to look at how that percentage changes when you're able to acquire the property with a low down payment on terms. So you can see for this property, the asking price, $395,000, owner carry terms, $45,000 down, 6% interest rate for a 5-year loan term. So now that's amortized over 30 years, but that means that the seller is willing to carry paper and finance the property without a bank for a 5-year period before a balloon payment is due. As many of us know, the commercial lending market is near impossible to get quality terms with a low down payment right now because of the financial markets being what they are. So if you're able to acquire property with a seller carry with a low down payment in that 10% range like this, it's an exceptional buy, and that's what we typically shoot for to make this strategy really work. So okay, so we've got our terms there. So if we put $45,000 down, our financed amount is going to be $350,000 with our $395,000 purchase price. So at 6%, that would be a $2,100 payment to your lender every month. Okay. So to find out what our new NOI is, we're going to take our annual debt service, our payments, and we're going to deduct that from our $42,000 NOI. So in this case, our annual expenses as far as the payments to the lender is going to be $25,200. We're going to deduct that from $42,000, and that leaves us with a $16,800 net operating income. So now, to get our new cash-on-cash return on investment, you're going to divide your net operating income by your total cash investment. Now, in this scenario, you're not investing $395,000 cash anymore. Now all you're investing is this $45,000 down payment. And since the property is cash flowing and makes the monthly payments and then some on its own, that's the only investment that you ever make for the lifetime of the property. So we take your $16,800 NOI, divide that by your $45,000 total cash investment, and that equals a 37.2% cash-on-cash return. So you can see, as opposed to up here where we have a 10.8 cap rate, cash-on-cash return, now by purchasing the property with $45,000 down, roughly a little more than 10%, we're able to more than triple our cash-on-cash return. As you can see, in addition to that, you still have that additional capital to work with to acquire other properties and really spread yourself around and maximize your buying power. So we understand that that's clearly the better way to purchase income-producing property if you have the ability to do so. But still, $45,000 is a lot of money to some people to put into one property. So what we've done with the group investing is we create an entity specifically for each property that we purchase. We bring in no more than 4 investors total per property. We typically will shoot for 2 or 3 to share the risk, share the reward, and own the property outright. So in this scenario, we have 3 investors come in with $15,000 each. They receive 30% deeded ownership in the subject property. Each entity is only formed for that property. So this is not something where you invest money and then it's spent recklessly over several properties. This is a specific entity forms for a specific property that you've approved and expressed interest in investing in. So in that scenario, you actually are able to purchase 30% deeded ownership in the subject property for $15,000 total. Now, since the property is cash flowing, that $15,000 theoretically is the only investment that you ever need to make during the 5-year period that the owner is carrying paper. Obviously, with inflation, we're expecting that during that next 5 years, we're going to see devaluation of the dollar, and that's going to create an opportunity for us to repay the loan balance with cheap dollars or sell the property at its new increased value because the dollar has become so weak. Effectively, what this is an excellent way for you to maximize your buying power, pool your money with other investors with the scenario that we have here. For $15,000 total cash investment, you're actually able to purchase a property that's worth nearly $500,000. So that wouldn't be possible without group investing, and the return, in this case, even with it being 30% as opposed to 100%, you're still going to see a 35% plus cash-on-cash return. So that's a brief rundown of how group investing works. We'd love to talk with you in more detail about specific properties we have available and how we can work together. Thanks so much.